Hey everyone, this tutorial introduces you to the owner's drawings and the statement of owner's equity and corresponds with the first note in this section of our course as well. So let's get into owner's drawings. So in a nutshell, owners have the right to take money out of the business because they do own the business. So if they want to do that, they do a equity transaction, but not through the owner's capital account, through a new account called owner's drawings. So that's where we are going to be tracking when the owner chooses to take some money out of the business. So to this point, the owner has only invested in the business. The owner also has the right to take money out of the business. And you can read more about that in this note as well. So I'll be doing a bit of a Reader's Digest version on this note. Because the owner is taking money out of the business, their overall equity is going to decrease. So even though it is an owner's equity account, which is a minus plus account, owner's drawings actually act in the opposite and they are a plus minus account. So they increase with a debit and decrease with a credit, which is a bit confusing because it's the opposite to what we've learned to date about owner's equity accounts. And you'll just have to get used to that. You just have to think if it's not good for the owner's investment in the business and taking money out is not overall positive for the investment in the business, then it has to decrease our overall equity in the business. Okay, so here's an example here, and I'll be moving my face around a little bit here to see the slides. So in this case here, we had an owner who took out $1,000, but in my transaction it actually says 150. My bad. Just change that on the fly. $150 for personal use. So our cash will decrease by $150, and then our drawings will also will increase actually because we're taking more drawings out, and that will make our capital lower. So it's going to be debit drawings 150, credit cash 150. All right, so we've done income statements, and what we didn't talk about was the impact that income and revenues and expenses have on our capital. So in this slide here, you'll see if I'm going to do an overall T account on owner's capital, on the right-hand side, because capital increases with a credit, we'll see a couple of items that increase the overall capital. The one is an owner's investment. So when the owner invests money into the business, their equity is going to go up. The second one is when we make revenue, that revenue belongs to the owner. So you're going to see in a moment, this might be a little bit confusing to you right now on this slide, but don't worry, we will work through this. When a company earns revenue, that revenue belongs to the owner. Therefore, it increases their overall equity in the business because they get more money into the business that they haven't borrowed. So it's not a liability. So when we sell something, it's really good for our business and the owner gets that money. Contrast that with expenses, so salaries, advertising, and other expenses we have to do to run our business. They draw down our capital because we have to pay those out. So the difference, the net income, increases our capital. If we have a net loss, it decreases our capital. And again, in this unit, we'll look at that a little bit more. Excuse me. So if you're a bit confused, don't worry about it. We'll get into that later on this week. Okay, so a statement of owner's equity is a place where we show how the owner's investment in the business has changed over the course of time. And what impacts that is our revenues, our expenses, and any drawings or investments that the owner has made. So let's take a look at one here. This is what a statement of owner's equity looks like, and there will be an example in D2L as well. So at the top we have our who, what, and when. So in this case, Hills Sports Company. It is a statement of owner's equity, and like the income statement, it's for a period of time. So you'll see for the month ended November 30th, 20 dash dash. Now this is a 3-column statement. The first column shows the changes that have happened to our statement of owner's equity. So over the course of the month, what's happened to the business. The second one shows our original balance along with any subtotal of the change. And then the third column simply shows what our updated capital is. So if you look here, the owner had a capital of $90,680 at the beginning of the month. During that month, they made $2,450 in a net income, and they also drew or withdrew $1,500. So if we take that $2,450 minus the $1,500, it means our equity is going to go up by $950. So The owner took out $1,500, but the business also made $2,450, which belongs to the owner. So to finish off the statement of owner's equity, we simply take our beginning balance, which was $96.80, add the increase in our equity of $950, and that gives us a new capital number of $91,630. That is the updated capital number for our owner. And as we go on in the unit, you're going to see we're going to need to do this in order for our balance sheet to balance out. So in the coming days, you'll see how that works. But the capital for November 30th is now 91,630. We take that forward so that December 1st, that is what we would show as the owner's capital, and then we would update it again at the end of December. So that's the tutorial for this. I'm not going to do a spreadsheet for you because you've done enough spreadsheets, and you can see here that there are 3 columns, and you can see where the dollar signs and underlines go. So you can use this example, and it will also be posted as an example on D2L. Reach out if you have any questions, and head to D2L to work on an exercise now. Cheers.